Most people misunderstand money. They treat it like a fuel meant to be burned quickly for the next investment, the next trade, the next fleeting opportunity. But I've learned often the hard way that money is not just fuel. It's also a shield, a weapon, a strategic reserve, and so when people ask me, why do you keep so much cash just sitting in your bank account? My answer is simple. In times of uncertainty, most people seek shelter in illusion in models, projections, forecasts. They try to shape the world with spreadsheets, believing that stability can be quantified. But markets are not built on certainty. They are built on human behavior, which is flawed, biased, and reactive. That is why I don't place my trust in predictions. I place it in liquidity. Liquidity is not a passive position. It is the most active form of discipline. To hold cash and to do so deliberately is to refuse the seduction of overexposure. It is to admit that you do not control outcomes, but you can control positioning, and in times of chaos, positioning is everything. When markets become volatile, most players are caught on the wrong side of leverage. Their assets become liabilities. Their confidence becomes panic. They are forced to sell not because they want to, but because they must. They liquidate positions to cover margins, to pay debts, to stay solvent. And in those moments, prices collapse not because fundamentals change, but because psychology does. That is when liquidity becomes power. It gives you freedom. Freedom not to react, but to wait. Not to hope, but to observe. Not to scramble for survival, but to choose from opportunity. The player who is liquid in a crisis is not just safer, they are stronger. Because when valuations disconnect from reality, when fear drives prices far below intrinsic worth, it is only the liquid participant who can act decisively. And in that action, they do not merely protect capital, they compound it. There is a misconception that holding cash is equivalent to standing still, that it is somehow wasteful, that it loses to inflation. But that view is simplistic. It assumes a linear environment where capital deployed is always superior to capital held. But the real world is non-linear. It moves in sharp breaks, paradigm shifts, and systemic shocks. In those moments, cash stops being a placeholder and becomes a competitive weapon. In financial markets, the greatest asymmetries emerge not during growth, but in collapse. Most people chase returns. But the real opportunity lies in dislocation. To take advantage of dislocation, you must be unbound. You cannot be scrambling for liquidity when everyone else is. You must already have it calm, available, patient. This is not about timing the market. Timing is impossible. It is about being prepared before the inflection point arrives, because when the cost of liquidity spikes, it's too late to obtain it. The window closes quickly. And those who lack it are at the mercy of those who possess it. I have seen institutions fail not because their ideas were wrong, but because their positions were illiquid. They could not absorb the shock. They could not wait. They were forced to act under pressure, and in doing so, they destroyed themselves. Liquidity protects against that. It is not just a cushion, it is a shield. It creates room for reflection, room for clarity. It reduces the noise. In the frenzy of collapsing markets, liquidity is the one thing that allows you to remain rational, and rationality, in those moments, is a superpower. What makes liquidity powerful is not just its defensive value, but its offensive potential. Once the crisis passes, those with cash are not merely survivors, they become buyers of last resort. They pick up assets at distressed prices, not because they timed the bottom, but because they were ready when others were not. This is why I keep liquidity, not because I am risk-averse, but because I understand the nature of risk. Risk is not static. It morphs with perception, with leverage, with speed, and when uncertainty rises, those without liquidity lose their optionality. They are no longer in control. They are participants in a game they cannot pause. I prefer to remain outside that game until the rules change and then enter with strength. In uncertain markets, liquidity is not a luxury. It is the last true form of power, not because it grows wealth in the short term, but because it creates asymmetry in the long term, and asymmetry, properly exploited, is what builds lasting advantage. Not all capital is equal. The most valuable capital is the kind that moves when you decide, not when you're forced. That is the essence of liquidity, and that is why I hold it. Most investors treat cash as a dead asset, unproductive, idle, waiting on the sidelines while real money is made elsewhere. They see it as something that must be deployed, put to work, transformed into equities, bonds, real estate, or alternatives, but that view is shallow. It reflects a misunderstanding of value, of timing, and above all, of control. Because what cash offers when used correctly is not inertia, it's optionality. Optionality is the right, but not the obligation to act. In finance, this concept is often confined to derivatives, calls, puts, structured products. But in truth, optionality is a mindset. It is a framework for navigating an uncertain world, and cash is the purest, most flexible form of it. To understand this, you must first accept a basic truth: the future is not predictable. Forecasts are fragile, models break, the variables change faster than our ability to update the equations. Most strategies fail not because they're poorly designed, but because they depend on a future that doesn't arrive. In such a world, the rigid lose, the liquid win. Cash allows you to stay liquid and therefore adaptive. It lets you wait without pressure, observe without distortion. It gives you time to gather information, watch behavior, and recognize mispricings as they emerge. You are not forced to act prematurely. You don't have to chase. You don't need to convince yourself that the current opportunity is the only one. Cash gives you the ability to choose when, where, and how much to act. That is real power, not the ability to predict the future, but the ability to respond to it. And there's a psychological benefit as well. When you're holding illiquid assets or leveraged positions, your perception becomes biased. You see the world not as it is, but as you need it to be. You begin defending your exposure rather than thinking clearly. But when you're holding cash, your mind is free. You have no emotional attachment. You can assess reality with sharper focus. In a chaotic system, optionality is more valuable than precision, because when conditions change rapidly, it is not the most informed who succeed, it is the most flexible. Cash gives you flexibility. It allows you to engage asymmetrically. That means you can enter opportunities that offer limited downside but unlimited upside, the kind that others can't touch because they're already committed elsewhere, the kind that appears without warning and disappears just as fast, the kind you only benefit from if you can move instantly. But optionality isn't just about upside, it's also about protection. When things go wrong, as they inevitably do, cash gives you the ability to retreat, to reassess, to defend. It buffers you from the cost of being wrong. In a world where certainty is a myth, that buffer is not just useful, it's essential. People often ask, isn't holding cash a waste, especially in a world of inflation? Doesn't it erode in value while other assets appreciate? The answer is nuanced. Yes, in stable environments, cash appears to underperform. But those environments are the exception, not the rule. In unstable conditions, cash outperforms not in yield but in opportunity, because when volatility strikes and valuations collapse, the person with cash doesn't lose, they gain. They are not forced to sell, they are in a position to buy, and they do so when the return on capital is highest, not in theory, but in practice. Optionality is undervalued because it doesn't show up on spreadsheets. It doesn't compound visibly. It doesn't impress during bull markets, but it becomes undeniable in moments of stress when the path splits, when liquidity dries up, and when only the prepared can act. That's the paradox of cash. It's most valuable when others view it as least desirable. When greed is rampant, holding cash is mocked. When fear dominates, it becomes priceless. I don't hold cash because I distrust opportunity. I hold it because I understand timing. Not all moments are created equal. Some are crowded, overpriced, and fragile. Others are rare, misunderstood, and full of hidden upside. The difference is not in the assets, but in your ability to choose your moment. Cash gives you that ability. It is not the absence of strategy. It is a strategy in itself, one rooted in humility, patience, and control. In a world that changes faster than conviction can keep up, cash is the most underrated form of intelligence. It is not weakness, it is waiting with intent. In finance, the temptation to predict is almost irresistible. People build entire careers, institutions, even national policies on the illusion that the future can be forecasted. Charts, models, algorithms, all designed to tame uncertainty, to impose order on chaos. But the truth is far more uncomfortable. Prediction is often an exercise in arrogance. What endures, what truly matters, is preservation. Preservation over prediction is not just a strategic principle, it's a worldview. It begins with the recognition that markets are not stable systems. They are complex, adaptive, and deeply psychological. Participants do not act on perfect information, they act on perception. And perception, by nature, is flawed. In such an environment, trying to predict outcomes becomes less effective than ensuring you can survive outcomes you didn't anticipate. Preservation means staying in the game, because if you cannot endure volatility, if you cannot withstand shocks, if your capital disappears in a single miscalculation, then no prediction matters. There is no next opportunity for the one who is wiped out. This is where most investors fail. They overleverage based on conviction. They extrapolate trends into the future as if cycles don't exist. They bet too big on what should happen rather than hedge against what could happen. And when the unexpected arrives, as it always does, they're not just wrong. They're destroyed. Preservation is not about fear. It's about understanding the true nature of risk. Risk is not just about probability, it's about consequence. Even a low probability event, if it carries catastrophic cost, must be treated with the highest respect. That's not pessimism, that's rationality. Prediction encourages precision. Preservation encourages resilience. Prediction focuses on being right. Preservation focuses on staying solvent. One flatters the ego, the other protects reality. To preserve capital is to accept uncertainty, not to fight it. It means building buffers, maintaining liquidity, diversifying intelligently, and most importantly, avoiding irreversible losses. Because time is only your friend if you're still in the game. Compounding works wonders, but only on capital that remains intact. There's a fallacy in modern finance that says exposure equals bravery, that risk taking is synonymous with sophistication. But the most sophisticated players are often the most conservative, not because they fear risk, but because they understand it better than anyone else. They don't aim to predict with perfect accuracy, they aim to survive every cycle. The market rewards those who endure, not necessarily those who outperform every quarter, not those who guess the top or bottom, but those who protect their downside, who stay liquid when others are panicking, who can deploy capital when assets are mispriced, not because they foresaw the crash, but because they remained unbroken by it. Preservation creates optionality. The longer you stay solvent, the more chances you get to act when opportunity arises. And in financial markets, opportunity is not a steady stream, it is a series of windows. Short, volatile, and deeply asymmetric. To capitalize on them, you must first be present for them. This is the flaw with most predictive models. They assume a normal distribution of outcomes. They underestimate tail risk. They do not account for panic, irrationality, or political intervention. They treat markets like closed systems governed by logic, but markets are social constructs. They are reflexive. Expectations shape outcomes, and outcomes reshape expectations. To predict them linearly is to ignore their core nature. Preservation, on the other hand, does not need precision. It needs humility. It is grounded in the knowledge that no model can capture the full scope of reality. That resilience is more important than brilliance. That wealth, once destroyed, is far harder to rebuild than it is to protect. I don't position for what I think will happen. I position for what might happen. And more importantly, for what must not happen. That's the key distinction. I don't need to be right. I only need to avoid being fatally wrong. The goal is not to eliminate risk. That's impossible. The goal is to structure exposure so that no single outcome, however extreme, can end the game. Because only then does the game continue. And the longer you stay in it, the more its rewards accrue not just to the bold, but to the wise. In a world obsessed with prediction, preservation feels boring. Conservative, passive, but when the system shakes, when volatility surges, when predictions collapse, it's preservation that keeps you standing, still thinking, still choosing, still compounding, and in the end, that is the only strategy that truly wins. The most dangerous assumption in modern finance is that the system is stable, that the rules are fixed, that institutions are sound, that central banks can always manage the consequences of their own interventions. But this assumption is not only wrong, it is a form of collective denial, because underneath the appearance of strength lies a structure that is profoundly fragile. Fragility in a financial system does not announce itself. It builds silently, hidden beneath layers of complexity. It accumulates in the form of leverage, of interdependence, of moral hazard. It's not the individual failures that reveal it, it's the systemic response when those failures occur. And the response, more often than not, is panic. Every modern financial crisis has followed a similar pattern, a long period of growth driven by cheap money and excessive confidence. Rising asset prices reinforce belief in the system's permanence. Risk-taking becomes normalized, debt expands, derivatives multiply, and then something small breaks. A default, a missed payment, a drop in confidence. The trigger doesn't have to be large. What matters is that the system is so tightly wound that even a minor disruption becomes a cascading failure. This is what people misunderstand about fragility. They look for the visible causes. But real danger comes from hidden linkages, from the fact that every part of the system depends on the stability of every other part. Banks depend on short-term funding. Corporations depend on low interest rates. Consumers depend on asset prices staying high. Governments depend on market confidence. And central banks, they depend on a belief that they can fix everything. But belief is not the same as control. And when confidence cracks, control disappears. The system we have today is not self-correcting. It is self-reinforcing. Central banks, in attempting to smooth out every downturn, have created a cycle where risk is never fully priced in. Each crisis is met with intervention, lower rates, asset purchases, liquidity injections, and each intervention encourages more risk-taking, more leverage, more dependence on the next intervention. The system becomes addicted to stimulus. Markets stop functioning as pricing mechanisms and start functioning as policy reflections. That is not resilience, that is fragility in disguise. What makes the system fragile is not just leverage, it's the belief that leverage is manageable. It's not just complexity, it's the belief that complexity is understood. People act as if the architecture of global finance has been stress-tested and proven sound, but what it's actually been is suspended. Suspended by monetary policy, by backstops, by the illusion of infinite support. This illusion works until it doesn't, and when it breaks, it doesn't break slowly. It breaks all at once. One of the most overlooked risks in a fragile system is reflexivity. The idea that market participants do not merely observe reality, they shape it. A falling price causes a downgrade, which forces a sale, which causes a further price drop. A rumor causes withdrawals, which becomes a liquidity crisis. Perception becomes reality, and that reality feeds back into perception. In such a system, stability is never static. It is conditional, dependent on continued belief. Once belief erodes, the mechanics of collapse are already in motion. You cannot hedge against systemic fragility with prediction. You can only hedge with structure, with cash, with optionality, with humility. Fragile systems punish overconfidence, especially when that confidence is institutionalized. People often say the system will hold, it always has. But that's not a strategy, that's hope, and hope is not a hedge. What's required is not a fear of collapse, but an understanding of its inevitability. Not in a dramatic, apocalyptic sense, but in the sense that cycles end, that trends reverse, that equilibrium gives way to disruption. A fragile system can appear stable for long periods, but when it fails, it does so because no one was prepared to absorb the shock. And that is where strength lies, not in forecasting the collapse, but in surviving it. True power in finance is not being the last one to ride the wave up, it's being one of the few left standing when the wave crashes. In a fragile system, that means holding liquidity, holding optionality, refusing to fully buy into the illusion that this time is different because it never is. Fragility does not mean failure is certain. It means failure is possible, and that possibility must be respected. That respect is what separates the reckless from the prepared, the believer from the observer, the gambler from the strategist, and in the end, when the illusion breaks, only the strategist remains. Cash is the most misunderstood asset in finance. It doesn't move, it doesn't yield, it doesn't impress. In a world driven by momentum, where performance is measured by speed and volatility is mistaken for brilliance, cash is dismissed as boring. But the truth is, Cash is not for show, it's for strategy, and its power lies in asymmetry. The asymmetry of cash is subtle. On the surface, it appears stagnant, even weak. While equities surge, while bonds yield, while private deals generate headlines, cash sits quietly. It earns little, it grows slowly if at all. But this surface-level boredom masks a deeper dynamic. Because in the right moment, in the right conditions, cash transforms. It goes from being a placeholder to being a weapon. The nature of asymmetry is that you risk little to gain much. Most assets don't offer this. Stocks expose you to drawdowns. Bonds erode in inflation. Real estate ties up capital and lacks flexibility. But cash is unique. It carries no directional exposure. It cannot collapse. It is dry powder, waiting. It holds optionality. And when prices fall, when liquidity dries up, when everyone else is trapped in the positions they believed would protect them, the holder of cash gains freedom. This freedom is not theoretical. It is actionable. It allows you to buy when others are selling, to act when others freeze, to move when others are stuck. The asymmetric power of cash lies in its timing. You don't need to win every day. You only need to be present when the odds shift violently in your favor. That moment doesn't come often, but when it does, cash turns from boring to explosive. Asymmetry is not just about return. It's about control, the control to wait, to say no, to observe, to prepare. Most investors are always deployed. They believe money must always be working. But when everything is always working, nothing is flexible. Cash, on the other hand, is pure flexibility. It is positioning without exposure, readiness without commitment. The market doesn't reward constant activity. It rewards precision, and precision requires patience. The mistake most people make is confusing cash with indecision, but in a world of crowded trades and levered risk, cash is not indecisive, it's selective, and selection is where asymmetry is born. Opportunities in finance are not evenly distributed. They arrive sporadically, often in crisis, when fear overshoots, when sellers outnumber buyers, when assets disconnect from fundamentals. That's when asymmetry explodes. But to act in those moments, you need liquidity. You need the capital that others wish they hadn't deployed. You need cash. There's a paradox here. The best returns are often generated when conditions are at their worst. But in those conditions, most are illiquid. Most are over-leveraged. Most are praying for a recovery. Very few are positioned to buy. This is why cash matters. It is not merely about safety. It is about advantage. And advantage is asymmetric by nature. It does not belong to the crowd. It belongs to the contrarian, the patient, the prepared, to those who are not seduced by trends, to those who understand that the most powerful capital is not the kind already invested, it is the kind that moves at the right moment. Yes, cash erodes with inflation. Yes, it underperforms in bull markets. But these are the costs of optionality, the price of staying uncommitted until commitment is most valuable. In asymmetry, small costs are acceptable if they grant access to large payoffs. And no payoff is larger than buying quality assets when no one else can. That is why I hold cash, not because I lack ideas, but because I know that most ideas are mistimed, most predictions are flawed. Most certainty is misplaced. I hold cash because I prefer not to guess. I prefer to observe, to understand, to act when the conditions are asymmetric, when the downside is limited and the upside is mispriced. Cash gives me that ability. It is boring until it isn't. It is forgotten until it isn't. And when the cycle turns, when the system stumbles, when the herd rushes for exits, it is cash that redefines the game. In the end, investing is not about appearing smart in the short term. It's about staying solvent and gaining advantage in the long term. And for that, there is no better tool than cash, quiet, unassuming, and capable of asymmetry when it matters most. I don't keep cash because I'm afraid of risk. I keep cash because I understand risk. Because true power doesn't come from leverage, it comes from control. And when the music stops, when the lights go out, and when the curtain drops, those with cash won't just survive,